One of the aspects of risk we might not have touched on, but is related, but perhaps outside of that of the investment risk, is sort of operational risk. And I would imagine things have changed a bit over the last 18 months in terms of your clients talking about that. Allison, I'm wondering, maybe I can ask you, what sort of has changed in your firm's approach to addressing the concerns around operational risk? Are your clients asking you about that more, and what does that look like?
Well, I think that all fund managers are being asked about operational risk questions a lot more since Madoff, certainly. Everybody, and rightly so. I think that investors are right to ask these questions, and what we've certainly done is really tried to make sure that our systems and controls have been firmed up, that everybody within the organization is speaking, no more silos, no more finance is siloed off from legal, from compliance, et cetera. But we are definitely getting a lot more testing and prodding and questioning from our investors, and we're happy to help and give them all the answers that they need to feel comfortable. But there's definitely a sense of nervousness out there, and I guess I would say that all fund managers are probably facing the same thing and should be doing the same thing.
Yeah. Eric, is that true? Are you guys seeing that same thing in terms of clients asking about?
Probably at the margin, would be the types of people bothering Allison. I think from our perspective, the investment team has always done the operations diligence work on the things that we're invested in, and I think we've done a good job historically. But I think there's a much greater emphasis today on focusing on both operations, service providers, asset verification, and understanding what kinds of policies, procedures, protocols people have in place internally on those things, as well as their own internal compliance. So I think it's an area of a lot of focus.
One thing on operational risk. I think I was actually at a Cap Intro conference for hedge fund in New York a couple of weeks ago, and one of the managers were having lunch, a competitor actually, and he was in fixed income and have done very well all the way up to 2008. And in 2008, he was down 45%. This is a hedge fund. It's a fixed income hedge fund. And the reason that he was down 45% was actually his prime broker was Lehman Brothers. Right? So Lehman essentially, I think 17% of negative return was actually attributed to the fact that Lehman essentially didn't return the assets. And the other 10% was actually as a result of when you're doing long short, if you lose your swap, you lost your short, you become net long in third, fourth quarter 2008. That didn't end very well. So I think, and 2009 he's actually had a fantastic year, but it's actually highlighted really a very important issue in terms of thinking about. I think typically, I actually, in addition to teaching at NYU, I actually teach a risk management class at Berkeley. And by the time you talk about market risk, you talk about credit risk, by the time you get to operational risk, everyone starts to fall asleep. But I think in real life, the operational risk is actually extremely important in the sense that, given what we've actually gone through, and also just in terms of, again, I want to emphasize a bit more on institutional platform, in the sense that even in the hedge fund world, I think more and more people, our clients are actually demanding institutional quality in terms of platform. You have 2 or 3 guys opening up a hedge fund. I think that's probably the go-go days of the hedge fund. I think increasingly, the clients, the institutional clients, are looking for hedge fund managers or absolute return managers who look and feel very much like themselves, who actually have an institutional platform, who have actually a team that actually can do the due diligence, who can diversify across different prime brokers to make sure that the next Lehman happens, that you actually, instead of having one prime broker, that you actually have 3 or 4 prime brokers. So I think the institutional platform is actually becoming very, very important after the crisis we've actually gone through, and I think it's actually going to become even more important going forward.
So before asking the question, which I'll let you ponder as I ask this first one about regulation and do we need more of it, I'd like to just get a general comment from the panel on managing client expectations. We've touched on lots of different points, all related to policy and really how you guys are sort of adjusting your strategies. But how, specifically as it relates to interacting with your clients or even choosing your next clients, has anything changed in your perspective on that? Obviously, you guys are talking more, like I would imagine, trying to be more open and talk about things like volatility and risk management more. But what, in terms of your general approach to managing client expectations, has changed, if anything? Anyone care to comment? Clients love the clients are all good.
Well, I can say from our perspective that we talk to our clients a lot, and there are some of our investors who would like to talk to us every day, and that's fine. And I think that we're very, very transparent in our fund. I think this has a lot to do with our strategy, though. When we go into investments and we acquire large positions, we file 13Ds. We're right out there. It's very clear what we're doing, where we're invested. If any of our investors, literally want daily information, they can have it. I think a lot of funds are that way as well. But we've just found that if there's a bump in the road, if there's a publicity issue, whatever it is, that we're better off getting out in front of it and making sure that we speak to our investors and make sure they understand our perspective and what we're doing. And I think that's been I think it's been helpful. I think there's nothing worse I would expect, although Eric may have a different view, for an investor being felt that they're kept in the dark. So I guess I'd answer that openness and transparency we found to be successful, and we hope that our investors have found it the same.
Yeah, I would agree with that, and I think that I think frequent communication, and then to the extent that people can understand what investment managers are doing at the investment level, they're much more well-equipped to be able to process month-to-month or quarter-to-quarter returns against what's happening in the market, which is really helpful.
One issue that we feel is important to communicate with clients is I guess a subtle way to say how to learn how to live with less, because when you look at the assumptions built into a lot of institutional investors like pension plans, particularly public plans, 8% is the assumption, and I think even the most optimistic model, given bonds at 4% yields and equity risk some percentage above that, presumably, hopefully, if the world continues to recover. You just can't get there from here. And so we're having these uncomfortable conversations. It's been increasing over the years that as bond yields have trickled lower and lower, and equity risk in a deleveraging world is becoming more and more real. We are having these discussions with clients saying, well, you can increase your equity risk, but that doesn't make sense. And you can decrease your the equity exposures, but then you're going to have to make it up somewhere. And we're going to be honest with them that alpha is not going to make up the difference. It could help as you orient more toward fixed income, perhaps considering more alpha-oriented strategies. But the reality is that everybody can't do that by definition. And so the general message is going to be learning to live with less. And what I'm seeing for the first time is actuaries. I met with an actuary of a large pension plan who has an 8% assumption. And he said, I've been kind of toying in the back office with a mark-to-market to reflect the reality of our funded status. And he's bracing for reality. And I think he's worried about how the messenger is going to get shot. But the fact is, somebody's going to get shot at some point. And as the taxpayer realizes that there's a lot of liabilities here that aren't going to be covered by assets growing at 8%. So the message that it goes with diversification is still one to live with less, and that means, unfortunately, somebody's got to make up the difference on the liability side or asset side. But anyway, that's the uncomfortable conversation when you ask, how are things going? That things aren't fine at all because of this uncomfortable issue. And once the actuarial world and the investment world wakes up to the liability to lower expectations, maybe decisions can be made. But until then, we're going to kind of pretend it's not there.
Yeah. Go ahead.
Just want to mention one thing. I think I mentioned at opening remark, which I think is actually we're increasingly seeing in our client base is actually that I think increasingly people are actually asking a bit more about not only what at the end of the year my return is. I think people care quite a bit about how you made that return, and being a Goldman Sachs shareholder is probably a good thing, but at the same time, I think increasingly the society is actually asking. I think the Capitol Hill hearing is actually very clear. I mean, while Wall Street may be okay on certain practices, I think the Main Street is actually is very keen on asking, how did you make that return? And the process of making that return. And almost there's a bit of a moral judgment embedded in it that is actually becoming increasingly important. And I think that's actually very important when all of us are sitting in different financial institutions. I think we all have, for different levels, I think conflict of interest. And I think increasingly the society is actually asking what kind of conflict interest do you have? And are you really performing this as a fiduciary mandate on behalf of their clients? And I think I really think that's actually a bit of a watershed event that I think, getting higher return is very much necessary, as Jim has highlighted, but at the same time, how you make that return and whether you're doing this, avoid conflict. Are you actually doing this, delivering higher return at the expense of some type of clients? I think that's actually going to become increasingly much more important focus going forward. So fiduciary responsibility, I think, is going to become increasingly important focus for our business.
Yeah, indeed. For a public fund to have a kind of a fiduciary qualification to be on that board would be a great step in that direction. Mm-hmm. I think we're going to see it legislated with these pay-to-play allegations going around, certainly in California and New York. But I think systematically, the problems are everywhere. We need to upgrade the fiduciary care to the point of certifying that they are capable of being a good fiduciary, and consequences for not.